Alright everyone, we continue with chapter 3, which is adjusting accounts and preparing financial statements. You are already familiar a little bit with both of them. We spoke a little bit about adjustments. You already did financial statements. We do more of it. Alright, everyone, class begin. The first concept is known as the time period assumption. And it comes from time period. In accounting, we divide everything into time periods. We divide usually into 1 year. When you have 1 year, you call this annually. So, if it's a report, we call it annual report. Okay? Then, we typically divide the year into. Everyone, again, no more talk. We divide it into 2 parts. We divide the year in 2. And its length is 6 times, and we call it semi-annual. In Americans, it's called semi-annual. Elon, move out, move far away, okay? You separate, okay? Yeah, just move, okay? Class start a while. Yeah, no, just go ahead and move. So that makes sure that you don't get in trouble. Just move a little bit far away, okay? And whatever the problem is, yeah, I mean, unfortunately, and that will be for anyone who continues to talk. Just a little bit, 2 chairs down, just 2 chairs, yes? So we can get, I mean, unfortunately, you know what kind of comments you get on YouTube about the lectures, about how bad you are talking during lectures. Yeah, you get that. You go on YouTube videos and you read the comments. You'll see that the comments are about you constantly keep talking and constantly disrupting. It's unfortunate, but that's life. I mean, I guess you got to deal, and one way to deal is lock the door, okay? And then move out. And then out of the classroom. Unfortunately, we got to do this. We still have half the semester left, and we got to learn. So for the next time, 5 or 8 minutes, I'll lock, and that's it. Okay? So, semi-annual is time frame between when we separate the year in 2 parts. So sometimes you get semi-annual reports. Soon enough, you'll have to separate the 2 of you. Soon enough, okay? Yeah, that's the 2 of you together. Then we have what's called quarterly. Quarter means 1/4. This one is quarterly. Means you divide the year in 4 equal parts. And each happens to be 3 months. And last one we have monthly. So these are the different time periods that we use in Western accounting system, which is now recognized in most places around the world. You have annual, semi-annual, quarterly, and then monthly. Okay? These they call H. H means half. So this period here is called H1, meaning first half period. And this is called H2. H, the letter H. This one is called Q, Q1. Q standing for quarterly. And this is Q2, Q3, Q4. Okay? And this, sometimes they call M. M1, M3, M5. Okay? The month, the 5th month. Okay? And annually, you just say 2012, 2013. Sometimes you just shorten to 12, 13, or 97, or 98. Okay? So this is called the accounting period. Every period represents a length of time. It has a beginning and it has a end. Usually the beginning is the beginning of the month and the end of the month. Okay. Now, the year, we call this fiscal year, doesn't have to be from January till January. Okay? It could be from April till April, from June till June, from August till August. Okay? So, this is not necessarily to be only from January. When it's from January, it's called calendar year. Calendar is the calendar that we all use. And if it's from March or April, in other words, from wherever the annual report begins, it's called fiscal year. So fiscal year 2013 could be from March till March. Okay? And sometimes when they have calendar, my textbook reminds me, it's called the natural business year. Natural business year. Okay. Accounting has two fundamental types, which people usually associate with this one, but this is not appropriate as soon as business gets relatively large. Cash basis means revenue is recognized when you receive, and expense recognized when paid. So, if you pay expense for 2 years of car insurance or auto insurance or some other insurance, if you pay for 2 years insurance, in a cash basis, you recognize the expense today for 2 years, okay? Which means that it overstates your expense. By the same way, someone, for example, you may plan to stay this and next year, your grades are good, you like university, you can pay your rent to the dorm upfront for 15 or 18 months, okay? And if the university is running on a cash basis, it will recognize the revenue today for all of the 15 months. So today's revenue is going to be big, and next month's going to be nothing. And that's not right. That's not good. That's not correct. Today, we prefer to use what's called accrual basis. Accrual means that revenues are recognized when earned. So, the rent for September will be earned during September, okay? Not during July, not during October, not during December. So, the rent will be earned during December. Hey, you still have to separate two. We don't do these things, okay? You're going to get a lot of comments on the internet again, all right? So, revenue, recognized when you earn it. And expense is recognized, again, when incurred. And the trick is that you have to match expenses with revenues. And expense is recognized so that it matches the revenue. And when it matches the revenue, this is called the matching principle. I'll be explaining more, and you're going to be getting a lot of exercise next time and examples, okay? You're going to get a lot more about it. So, here the key word is earn. And earn means when the product is delivered or when the services performed or delivered. So, if it's a rent, June rent is earned during the 30 days of June. That's when you earn it, okay? Alright? So, if a customer comes to a hotel and he pays beforehand for 7 nights, this is unearned revenue. He did not earn it. At the end of the first night, you can say, we earned 1 night, okay? So, let's say I'm just making a nice round number. Per night, 1,000 baht per night, okay? And the customer pays for 5 nights, 5,000. At the end of the first night, you can recognize 1,000. Okay? And the word recognize means you actually can record it in the accounting books. Okay? That's what recognize means. So, after 3 nights, you can recognize 3,000 out of the 5,000. Okay? So, that's what you do. Alright? Example will be, a customer comes for 2 weeks on Christmas. Well, what does it mean, 2 weeks on Christmas? They come on December 24 and they leave on January 7, for example, for 2 weeks, or 15 days, and they pay 15,000 baht, okay? When December 31st comes, when they pay upfront, you say, we earn 0. We get unearned revenue, which is liability. After 7 days, 24, 25, 26, 27, all the way to 31 is 8 days. You say, we recognize 8 nights of revenue. So 8,000 revenue is recognized. The other one, in other words, we say earned, and the other remains unearned. So every day you earn 1 night. Okay? And that's how it works. Same thing with rent. You pay 12 months rent in advance. So when you receive the rent, it is unearned revenue. At the end of the month, you recognize 1 month of revenue. At the end of the second month, you recognize revenue again. At the end of the third month, you recognize again. You will see a lot of examples about it. Okay. So, in accrual versus cash basis, this means usually not used or not allowed. This is where we say in a generally accepted accounting principles, everywhere around the world, you don't use this. It's called non-GAAP, generally accepted accounting principles. The same applies for international standards. And this one is what's called GAAP. So this one is recognized. This is the correct one. This is the proper one. This is the one you have to use, you have to learn. This is the one when you go in business, that's the one you're going to use. Okay, this one, not really good. Or when you try to do this one, you're going to get a lot of problems. As soon as the business grows a little bit, you're going to get a lot of problems here. Okay, so this is the appropriate one. Alright, so they just give you a simple example. I already gave you an example. You got fast forward, some company paid $24,400 for 20-month insurance, effectively 100 per month, policy beginning December 1. Okay, so what does it mean? So for here, in a cash basis, you recognize the full amount as expense on the one end. For the other one, those who paid say, oh, 24 expense. The other ones who got it say, oh, 24 revenue. But it's actually unearned revenue. When the end of December comes, the one party will have 100 expense, and the other one will have earned revenue. So when there is a payment of stuff like this, for the one side, it's going to be unearned. For the other side, is going to be, we call it prepaid. For the one who's going to be asset, for the other one's going to be liability. And after 1 month, the asset becomes expense, the liability becomes revenue. Okay, and that transition from asset to expense and from liability to revenue is called adjustment. That's the adjustment. So, on a cash basis, the entire 2,000 would be recognized as insurance expense for those who pay. For the insurance company, it's going to be recognized as insurance. Again, no insurance expense from this policy would be recognized in the next 2012 and 2013. That's on a cash basis. That's not allowed, not good. If you're working on accrual, you'll recognize expense 100 for December, expense 100 for January, for February, for March, for April, May, June, and so on, all the way till it expires. So the 2,400 you separate into 24 months, 100 each. And every month you recognize expense for the one business. Insurance company will recognize revenue on the other business, on the other side. Okay? And that's the accrual basis. You do this for rents. You actually have to learn all the situations you do. So you do this for rent, you do this for interest rates, okay? You do this for insurance, you do this for subscription. For the university, you do this for tuition, okay? Now, rent, do you pay your rent for the dorm every month or every semester? Okay, if you pay every semester, do you pay before the semester begins or at the end of the semester? Before. So if you pay before, for you it becomes prepaid rent. If it's before on the one side it says prepaid rent. It's also prepaid tuition. For the university it becomes unearned rent and unearned tuition. And every month they will recognize, if it's 4 months, okay, if it's 4 months, they'll recognize 1 quarter, 25% revenue on tuition, 25% revenue on rent, okay? So that's how it works. And every month they will, this little recognition is called adjustment, okay? You make an adjustment. All right, so the revenue recognition principle. I already said it, you got it signed. It is when you deliver a good or service, okay? So when the service is actually delivered. So if it's a hotel, in the morning you recognize the revenue, okay? Not in the evening. Only in the morning when after the customer has sleep. Same thing with a restaurant. After you deliver the meal, and usually after the customer eats the meal, only then you properly recognize. Well, when you go 7-Eleven, they deliver to you. You actually take the good or service at the cash register. The cash register is, if you pay, it's yours. If you don't pay, it belongs to 7-Eleven. So, when the moment of payment, you become the owner of the good. And if you become the owner, they effectively deliver to you. It's called the ownership, okay? You see, they delivered to you the rent today, but today is still July. The August rent isn't coming, okay? With a product, it's when you actually take possession and ownership. Only then you recognize a sale. Now, in the United States, this is a very important picture. There was a lot of big corporate fraud in 1999 and especially in 2000 when major companies delivering computers and technology and Cisco systems delivered routers and switchers, all sorts of technology. What they did is say, you recognize the revenue when the truck with the goods leaves for the customer and it leaves the gate of the warehouse. So when it leaves the gate of the warehouse and it goes towards the customer, then you recognize the revenue. So they did a classic fraud, okay? But it was perfectly legal in the United States. At 10 o'clock, they will get a few fake orders. Let's say a customer will order equipment for $20 million. Okay, let's say this university will order, let's say 1,000 or 2,000 iPads or 2,000 computers, okay? Each 1,000, so for 2 million computers, okay? They will load them on a truck, okay? And at 10 o'clock at night, they will leave the company, the warehouse. They say, we recognize revenue because the truck is going to the customer. And at 1 o'clock, the order is canceled, the truck turns back and delivers back the good, returns the goods at the customer. I see? So at 1 o'clock, you got to make the adjustment. Returns good. But at 11 o'clock, you have revenue. And 12 o'clock midnight is the report. So you increase your sales artificially. It's a lie. It's a fraud. But they used it to get a bigger, better bonus. Okay? So they use this fact that when the truck leaves the gate of the warehouse with the good, that's good enough for actually recognizing the revenue. And they use this regulation. Okay? But typically, we don't have these problems. If you go and pay for your textbook downstairs, as soon as you pay and you get your textbook, it's yours now, they can recognize the revenue. Same thing for 7-Eleven. You get your tea and you pay, it's yours now, so they recognize the revenue. Alright, so what do we have here? Recognizing revenue and expenses. I just explained, we have two names here. Number one is called the matching principle. It is also known as the expense recognition principle. So, you have a revenue recognition principle, which is when the good and service is delivered. And then have the expense recognition principle. The expense recognition principle is known as the matching principle. And the matching principle says that you recognize expense only during the period and only for those activities for which you recognize revenue. So, if you made it to earn revenue, you recognize it as an expense. Example, if they pay me now a salary for this month, okay, if they can recognize it as an expense if they recognized for you the revenue from tuition, okay? So there has to be some revenue generation in order to have the expense going on. Here's an example where expense is not an expense. It's actually not an expense. Let's explain. You are building a hotel. And when you build a hotel, you say, order, let's say, order bricks. And you put the bricks together and start building. The cost of the bricks is not an expense. It's part of the building of hotel. Then you pay salaries for workers. When you pay salaries for workers, that's not an expense. It is part of the value of the hotel. So the bricks, value of the hotel, the workers' value of the hotel, then windows, pipes, air conditioners, lights, switches, everything that you spend on the building is not expense. It's an investment, okay? It is part of building of the cost of hotel, okay? Let's provide a simpler, easy example. Easy example is, you got a little restaurant with 6 tables and you want to buy a nice, luxury, high quality table that can easily cost, I don't know, 2,000, 5,000, 10,000 baht. When you buy a table for 10,000 baht, which you're going to use for 5 years, okay? You're not going to say expense of 10,000 baht, okay? You're going to say purchase table, okay? And then every year the table value, you will, it's called depreciate, okay? That's why the same thing when we do, when you buy equipment like a computer, we don't say equipment expense, we say credit equipment, it's the machine, okay? And then you say, debit equipment and credit cash, okay? So when you buy something which is a long-term asset, something that you're going to use for a long time, like equipment, like a desk, like chair, like table, you're going to use it for more than a year, including insurance, you will not recognize it as expense. You will recognize it as expense as you use it. Okay? Example, you got right across the street a little business which is renting motorcycles. Okay? When they purchase one motorcycle which they will use to rent, okay, is it an expense? And the answer is no, it is not an expense because there was no revenue coming for the purchase of it. When you buy, all you do is you increase number of motorcycles and you decrease your cash. If you say this motorcycle I'll be renting, let's say for 3 years, and the cost is 36,000 baht, okay? When you rent it the first month, you're gonna have an expense of what is it for 3 years? It's gonna be 3,000 baht, okay? Right? So if it's 36 months, 36 months, yes, 36,000 baht. So it's going to be 1,000 baht per month. That's going to be the cost of the business. So we're going to recognize 1,000 expense. When he rents it to me for 2,500, he will recognize 2,500 revenue, and for that 1 month of use, he will recognize 1,000 as an expense. Okay, and he will recognize at the end of the month. He will recognize the difference between 2,500 revenue and 1,000 expense. He will recognize as a profit from renting the motorbike. So at the purchase of the bike, there is no expense. At the end of the first month, when he rents it and gets a revenue, he will recognize the expense. Same thing, when you buy the table for 5 years, when you put it in the restaurant, at the end of the first month, you will recognize the expense. Now, the expense on a long-term asset, like motorbike, like car for a taxi, like chair or table or projector, is called depreciation. Depreciation is the loss of value of an asset because it was used as normal. So you have a motorcycle, you're renting, after 3 or 4 months, the motorcycle is almost gone. It's depreciation. And from depreciation you have what's called, and here's the key word, depreciation expense. So you got a motorcycle, you got equipment, you got to have depreciation expense. And depreciation expense comes with, based on the matching principle, with using it as you use it to generate revenue. Okay? And so as you generate revenue, you will recognize the usage of that computer or laptop or projector or whatever it is. Okay. So, back to adjustments. You have a number of adjustments. You have 4 types of adjustments. All adjustments are just 4 types, okay? We already know and have examples. So first, adjusting entry is reported to bring an asset or liability to its proper amount, okay? Example will be, you have, oh yeah, let's use this one. This is water, okay? The university, I'm just making a number, they just bought 1,000 bottles of water, okay? And when they buy 1,000 water as a bottle and they put it in there, in the room, okay, is it an expense? Not an expense. It is a supply, a water supply. They have 10,000 bottles. I'm picking a number. 10 baht each, probably 100,000 baht is water supply. Okay? So, expense becomes as we drink it. When we consume it, that's an expense. At the end of the month, they will count the number of bottles. And they say, we got 8,000 bottles available. Well, what does it mean to have 8,000 bottles available? It means because you purchased 10 and you have 8, you've consumed 2, okay? So when you consume 2, at the end of the month, you will recognize expense for 2,000 bottles at 10 each. You're going to recognize for 20,000 expense for that particular month. So they are not going to account for every single bottle every minute, okay? It's too much cost. At the end of the month, they're just going to count and say, oh, we got 2,000 consumed. And at the end of the month, they will make adjusting entry. Because the asset was 10,000 bottles at the beginning of the month, and you want to bring it to its proper amount, because the proper amount is 8,000. Just because you and me are drinking water from time to time. Just because it's used, okay? Same thing about these nice little markers that we use, okay? They probably buy 50,000 at the beginning of the semester. And every month they will count, or every 3 months, or every 6 months they will count. And the difference will be expense, okay? And expense will come through an adjusting entry to bring the, in this case, the asset balance to its proper amount. Okay, so it's very simple and very easy. All adjustments fall into 2 major categories. These are called categories. And you have 4 types. And all this, that's everything, okay? You just remember them all. One is paid cash before. And if it's an asset, I already explained to you, we call it prepaid, okay? So if it's an asset, you say prepaid expense. Remember, prepaid expense is not an expense. Prepaid expense is an asset, like the water, all right? Or like your rent, or like the tuition, okay? And if it's prepaid on the other side, you say unearned revenue. So, when you pay tuition 4 months in advance, for you is prepaid expense, which is an asset. For the university is an unearned revenue, which is a liability, okay? Remember, every transactions have 2 parties. And have 2 parties, whatever is on the one side, it should be the opposite. If it's a revenue on the one, it should be expense on the other. If it's an asset on the one side, it should be a liability on the other. Here, the prepaid stuff is an asset for the expense, and unearned, meaning a liability for the revenue. And that's easy. We've done this a lot of times. A lot of examples. Subscription. You want to be getting, let's say, health magazine, or for the guys it's going to be motorcycle magazine, right? And you pay your subscription, and 12 months they're sending you a magazine. Every month they send you a magazine, okay? For that case, you have a prepaid expense. And for them, when they get the subscription, is unearned revenue. And every month, they will be recognizing 1/12 of it. And the other adjustment is when cash is paid after the expense is recognized. Okay? And the same thing for revenue. So you're going to have accrued. Okay, let's clarify the word accrued. Accrued, again, means that cash is paid after the event. Example, with the hotel I just gave you. The guy comes on Christmas, yes, 25th, and leaves on January 7th for 15 nights. But he's not paying before, he's paying on the last day. And if he's paying on the last day, on December 31st, you have, as a hotel, accrued revenue. Okay, accrued revenue. Let's provide another example that happens here in Thailand, as well as Bulgaria, America, Japan, and every other country in the world. It's called accrued taxes. Accrued taxes. Taxes are accrued usually on December 31st. Practically everywhere in the world, December 31st, you're a little person, you gotta pay your tax. Okay? But you don't have to pay it on December 31st. Okay? From January 1 till December 31st is called the tax year. Okay? But you don't pay it on December 31st. And you don't pay it on January 1. You pay it like April 15 for the United States. In Bulgaria, the date is April 30. Okay? So you have 3 or 4 free months. Okay? So at the end of the year, if you're a little business, you have a little restaurant, okay? A tiny little restaurant, you made, I don't know, 1 million baht profit, okay? And on 1 million baht, you gotta pay 10% profit tax. You have to pay 100,000 baht government tax, okay? If that's the case, December 31, you're gonna have accrued, it's gonna be tax expense. And accrued tax expense is a liability, which maybe you pay January, maybe February, maybe March, okay? By the date given by the government, okay? Before the date given by the government, okay? So at the end of December, you will have what's called a tax liability. And the tax liability is called accrued tax, okay? So you have these taxes which you gotta pay for the period. So you pay your cash, the tax after, okay? The government is the other side. They will have accrued revenue. For them, they will be expecting from your business the money, and they know they will probably get it, okay? But they're not going to get it in January 1. No one's going to pay on January 1. People in the West are drunk. They're not going to go. And they are sleeping till lunch. No one's going to go and pay the taxes on January 1. They usually wait until April. They usually wait the last week of the deadline to pay, okay? So, same thing applies to interest. For example, you have some bond or you have some account, okay, on the bank account, or have some bond. Let's say you purchase bond July 1, and they gotta pay you interest every 12 months, only every 12 months. Then they gotta pay, let's say, 10%. So you buy it for 1 million, and the interest for the whole year is 100,000. And for the 6 months, they gotta pay you, let's say, 50,000, okay? That is accrued revenue for you. You're not gonna get, you earned it, okay? You lend the money, you wait for 6 months, you earn the money, but they're not gonna pay it now, they're not gonna pay it tomorrow. They're gonna pay it after 6 months, because that's the contract, okay? So in that particular case, you're gonna have accrued revenue. So, stuff associated with taxes, stuff associated with interest rates will be examples. It's actually very easy to learn all the examples. There are about 15 or 20 examples associated with these 4 particular types of adjustments. All right, they have a little bit more. I already explained it. Prepaid expenses, okay? And that's what they say. Hey, here's a check for my 25-month insurance policy, okay? Well, it is a prepaid expense. And on the other side is unearned revenue. And here's what happens. You have, let's say, unadjusted balances, prepaid expense, okay? That's the, and then you have an adjustment. And this is the adjustment. So remember, adjustments for prepaid expenses are always like this. So if you have a prepaid insurance, at the end of 1 month, you're going to say credit prepaid insurance 100, and you say debit insurance expense 100, okay? So remember, that's very simple and very easy. You always have an asset and expense account. And on the other side, you have a liability and revenue account. The way to remember that all of these adjustments take a balance sheet account and income statement account. Every adjustment must have, on the one side, balance sheet. The asset is a balance sheet. And here, expense and revenue is the income statement. And that's it. That's all there is to it. And if it's a prepaid, the adjustment is always the same. Debit expense, credit asset. That's the adjustment. That's all there is to it, okay? Same thing with the water supply, okay? In a water, you got water supply. Okay, this is drinking bottle. So it's going to be bottled water supply, 10,000. And for the month will be debit, bottled water expense, credit, bottled water. Okay, same thing with these markers. Okay, separate. They'll have a separate. And that's all there is to it. So resources paid prior to, meaning before receiving the actual bill. So they're going to buy the water, but the benefit will come over the next 3, 4, or 5 months. You're going to buy the markers, but the benefit's going to come in the next 3 or 4 or 5 months. You are going to pay for the tuition now, but the benefit of learning is going to come over the next 3, 4, or 5 months. Okay? So that's what prepaid is. They give you the same example with prepaid insurance. It's $2,400. Prepaid insurance is an asset. Here you got insurance expense. And the adjustment is amazingly simple. Debit insurance expense, credit prepaid insurance. And that's all there is to it. That's the adjustments are actually, this is the shortest and easiest chapter in the textbook. I'm thinking of taking a break and then we continue, huh? Right? Okay.